by Dallas, make it hurt.
Good day, everyone. Welcome to another episode of Let's Talk Commercial Real Estate Investing, the Black Community Edition. I am your humble host, Dominic Green, managing partner, Technical Commercial Real Estate Services in the Dallas-Fort Worth market, specifically Dallas. Hope everyone's doing well this Wednesday, Education Wednesday. Out and about, but on the way to important meeting. But nonetheless, wanted to talk about today. I know I've been talking about, over the course of, I guess, weeks now. It's gone by fast. The year's almost over. Talking about the different sectors of, niches in commercial real estate, things that are happening, trends. The latest, which was the build-to-rent trend, and especially since I know two communities by History Maker come on the market for sale. They were built early this year. Well, they completed them, early this year. But with all that, we talk about on this channel, investing in commercial real estate for the passive income, creating value for all the stakeholders involved, working together, collaborating, partnering, sharing information, sharing knowledge, and then just listening to I listen to podcasts and conversations and stuff like that. And what I realized is that we never really had a conversation for those who want to invest or create opportunities versus others that just want to invest their money passively, right? And with that comes the ability to, in a sense, underwrite, but in a sense, do your due diligence on the opportunity. Obviously, the sponsor or the person that's in charge of the deal, the general partner. So for those that, like, man, I don't want to do all the work other than, put my money to work. I guess today I just wanted to briefly just talk about, kind of that process, kind of the things you need to pay attention to and do your due diligence on, from a person that, looks at offering memorandums on other investments, looks to do my own due diligence on opportunities, just to provide some insight there. So I guess the first and foremost thing is, outside of, buying real estate in a sense from in the stock form where you're buying like REITs and stuff like that. Most of the opportunities that you may see come through what's called a private placement, using the Reg D, Securities and Exchange Commission's rules, exemptions. So with the Reg D, and you'll see a lot in what's called an offering memorandum, which is basically just the sales brochure of the opportunity that some group is presenting, right? And in there they'll talk about, this is a 506C offering, this is a 506B offering, this is an A+ offering, so forth and so on. And basically those regulations are designed to stipulate who is the target audience, right? From the SEC rules, 506C is going to be mostly your accredited investors, and those are individuals that, have a net worth of at least $1 million, excluding their home. They individually make $200,000 or more. If they're married, they make 300 plus, right? Or maybe they're a business and it's $5 million net worth, right? And you have the 506B, which is the same thing, but it's a combination of accredited and non-accredited, or what they classify as a sophisticated investor. So someone that has an understanding of, somewhat understanding of what they're investing in, either through, practice, trade, experience. But with that, these offerings they're limited to about 35 sophisticated investors. And then there's other regulations as far as like advertising and stuff like that to get into that. So that's to start with. So then you have your offer memorandum, you have your private placement memorandum, and basically you'll hear the jargon PPM. And what this PPM is basically is laying out to you how you're basically going to lose your money. So from a person that's putting together the deal, it's kind of one of those things where it's a disclaimer, like, hey, what you're about to invest in, you could lose all your money. Here's how. Here's why. Then you also have the operating agreement, and this is stipulating, if you're investing into a particular deal and you're buying membership units, shares, or whatever, how is this going to operate? And the most important thing that you're trying to figure out is, okay, do I have any rights, like voting rights in the deal? Who's getting paid? What and what percentage? So typically some offerings offer a preferred return, and that basically just means that a certain percentage of any of the cash flows after everything is paid for is going to go to typically the investor, the person who's getting the preferred. And then after that, it's either split or it goes through a waterfall or some sort of arrangement between you as an investor and then the person that's leading the deal sponsor or GP, right? So in there, with all these documents, you're looking to see what type of rights you have, understanding the deal, obviously the market, really understanding the sponsor and understanding their track record, and then looking at key things like their assumptions, right? So one thing you realize is that depending on the person's assumptions when they're underwriting a deal, they can make anything a deal, right? So you want to see how conservative and then how far-fetching are their assumptions, right? And typically, especially when you've seen a lot of multifamily stuff, especially if you're on Facebook or something like that, you'll see the advertisements for it. This is a 506C offering, or A+ offering, that they are, hold on. I'm sorry about that. All right, that the assumptions are, so kind of your big trigger points is basically what's called a reversion cap or an exit cap. And this is like, hey, we're buying this deal at a certain cap rate. And for those who don't understand what cap rate is basically just a multiple. If you're trying to reference it to like stocks and things like that. But for real estate, it's basically your return on your investment if you paid 100% cash at a deal, right? So you bought something for $1 million at an 8% cap rate. That means that you're going to get an 8% return on that all cash layout that you put, or investment you put, of $1 million, which is basically 80 grand, right? So with that, the value of real estate, if we're going back to the fundamentals, a commercial real estate, that is based on the income that it generates, or the potential that the income that it generates, right? And to get that value, you use the market cap rate, what people on the market is trading for, are willing to pay for a particular amount of cash flow, right? So, a lot of times on these deals, especially now, some sponsors will get very aggressive, which, from a rule of thumb and what has been traditional, anything, if you bought something at a 5 and you're holding it for, a couple of years, typically 5, some cases 3, if not longer, most of the time that exit cap is going to be about 100 basis points higher, or 1% higher, right? Based on a couple of things. You don't know what's going to happen in the future. Risk change, risk appetite changes, who knows? But theoretically, you're thinking over time, the cap rate will go higher, right? Now, with that expansion of the cap rate, that does bring down the value of the cash flow, the value of the property. However, over time, you're banking on that the property's cash flow position for when you bought it year 1 or year 0, 5 years in the future is going to be significantly higher. Thus, you're going to have a higher value because there's an inverse relationship there. Hopefully, I'm not getting too complicated, and hopefully I'm explaining it properly. But nonetheless, stick with me. Okay, so what ends up happening is that number gets in some people's offerings. Instead of they're being conservative and being the cap rate expands, the cap rate contracts, which in this current environment right now, especially here in Texas and some of the other major markets, if you're talking about multifamily, industrial, because there's so much competition, so much money that's chasing so few deals, there's been a compression. People are willing to take a lesser return just to put their money to work in these particular sectors, in these particular niches, right? So, going conventional, you would go higher in your cap rate, but you will see offer memorandums where next 5 years or so that they're believing in that if they bought it at 4, they can sell it at 3, right? So we know that, and if you actually if you actually play with the numbers on your calculator, or if you use software or anything like that, when you make that big of a change in that cap rate, there's a huge change in the value, right? So that's why I'm saying that you can make pretty much anything look good and make the numbers work to get the returns that you project and you offer. That's another thing. Are the projected returns within reason, within a normal range, right? So somebody's saying, hey, this deal here, we're doing, very minimal work to a property, and we're going to get a 30% return IRR, right? Now, IRR is just basically your return over a period of time, considering the actual investment, your cash flows. It's basically a time value of money, right? So, most people wouldn't know, but, if you're talking about 30% IRR, typically you have to do a lot to the property, right? Or any property. There has to be something, you have to be bought at a basis, and there has to have been, minimal cash flow, like in distress, right? To where you're going to go in and invest all this money and improve the property significantly, a deep value add in most cases. Or you're doing a development deal, so it's something that's ground up, right? So most times, at a minimum, if somebody's doing a ground up development, they're looking for an IRR of about 25%, right? 25% or higher, or somewhere in the 20s, just especially given the conditions of land, cost of land now. But theoretically, it's in the 20s, right? Plus. So right off bat, by knowing that, if somebody's telling you they're buying a property, they're probably going to put like a couple thousand in there, if that, and they're going to say they're going to get this huge return, that should prompt a red flag. It definitely would prompt one for me, because I'll be like, okay, either what's really going on with the property? I need to know more about the property. I need to know about what's this business plan, because every offer memorandum is going to have some type of business plan on how they're going to create value and get you this return, right? So I look at the IRRs, the returns in there. I look to see if this offering also has a preferred in there, especially from, and it varies, it could have preferred, or maybe as from a limited partner standpoint, we have a larger ownership of the deal. So a lot of times, if you have a larger ownership of the deal, it usually equates to the preferred return that they were trying to give to you. It's just a matter of preference, especially who you're dealing with. If you'd rather have the preferred return, which in most cases I would, So because from an investor standpoint, let me get the first dollars in. I put probably majority. We put majority of the capital up. Let's be the first ones to get dibs on it first, right? So again, talking about the assumptions, the IRR, the cap rate reversion rate, the reversion cap rate, and then I also look at their assumptions from the operation standpoint, and then the rent growth, right? So, yes, right now rent growth is ridiculous, right? You look at some of these trade out, and again, I'm talking mostly multifamily at the moment when I'm talking about trade out reports. But what that basically means is the new leases that the property or the property management company is signing now, and the new renewals that they're doing. So right now you're seeing increases in rent anywhere from 5 to 12%, and that's been the trend somewhere in there for probably the past couple of years. And again, you have to make a bet, is this going to be a trend that's going to continue? So when you look at someone's, because typically they're going to have a pro forma in there, and then their assumptions. And their assumptions is like, hey, for the next 3 years, rent growth is going to be 8 to 12%, 8 to 10%, right, for the next 3 years, which it may not happen, but you don't know, because again, this is an investment, right? Everything is a risk. So if they're that aggressive in there, you probably want a more substantial understanding of why they believe they can get that. But for me, I would think more conservatively, like, well, hey, at the very least, you need to be the lower single digits. Normal, on average, you'll see 3% rent growth, or 3.5% rent growth. Your expenses grow about roughly 2.5 in some cases. So you'll see a combination of that. So when you see stuff like that, aggressive rent growth, aggressive cap rates, exit caps, aggressive slashing of expenses, because these are businesses, and there's only so much that you can cut on these businesses, on these properties, as far as running them lean. But if you run them too lean, you're going to affect the performance, which is going to cause people to leave, and then that's a whole other issue, right? So just paying attention to the assumptions is real key. Doing your due diligence on the property, doing your due diligence on the area. Why this area should we be invested in, right? What makes sense about this area compared to any other area? Those are things that I would pay attention to. So hopefully I didn't go over too much too soon. I'm probably going to do another video and just break it down in more detail in segments. But that was just kind of on my mind. I wanted to address it and to get people to start thinking about it. Because like I said, I've talked about properties and stuff like that, but I never really talked about from the investment standpoint for those who wanted to consider just investing, putting their money to work, and not necessarily wanting to put the deal together and stuff like that. So hopefully that was helpful. As always, like, share, subscribe, leave a comment. Leave a comment. If there's anything I can always do, definitely let me know. I'm always here to help. Like I said, this platform is for us to collaborate, work together, help each other, be a resource for one another, because we can do more together. Everybody has, no, it just got dark. Everyone has a particular gift, particular knowledge, experience that they can share, that they can help everyone, right? Because we can do more together than we can do individually. As my man Dr. Carr says from Howard University African American Studies, that I pay attention to on narrative and on YouTube, him and Professor Hunter. Oh, sorry about that. Lost connection there. Dr. Carr says, individuals don't beat institutions. It takes It takes a group effort. Business is a team sport. You know, as you can go fast alone, but you can go further together, right? So with that, like I said, like, share, subscribe, leave a comment. I'll definitely elaborate on that, but it was something on my mind, so I've just kind of shot from memory, movement and memory, right? The things that I've been doing, looking at while also on assignment, while also working to connect with people who have the same mission, are mission-driven, want to tackle affordable housing, preserving affordable housing, and leveraging that into other opportunities. Because especially, you know, it's one of the ways with multifamily you can affect the community. You might have, in some cases, control the outside, but you can definitely help influence the inside of the community. You could provide services, doing more with the capital, in a sense, for people other than just, you know, not saying it's, you know, you got to provide a return. That's one thing, because as we talk about, with, you know, there's no non-profit without profit, right? So you got to do that. But there are, with that, you know, beyond the initial number return, you can make a return on investment and make change in people's lives and have a trajectory for them as well. Especially given in our community, you know, talking about financial literacy, talking about just investing in general, changing our habits from being consumers to acquirers, right? Acquiring equity. We should be definitely focusing on, you know, getting more equity in businesses, creating equity opportunities, than necessarily just spending and being a consumer in a sense. Because, you know, when you own stuff, you have a little bit different type of leverage, influence, as opposed to someone who's always spending, giving the money away, right? So I think, you know, it's part of the process. Teaching that, teaching us to love one another again, work together again, not necessarily be competitors, but be collaborators, right? Working on doing more of that. So again, platform that, you know, that we come every week just to have a discussion on things that I know about, things I'm continuing to learn about, being an outlet as well, and just, you know, spreading the word, hopefully, and enlightening us that there are other opportunities out there. And it just so happens that, you know, for me, commercial real estate, I believe, is one of them. So again, like, share, subscribe, leave a comment, leave a like. Let's have a discussion offline as well. Definitely reach out to me if you need any help, if you want to talk about anything different. Join the Facebook group. Love to get more conversation going outside of that.
These my dollars make it hurt.